Well, hello there. It's Monday, September 9th, and the question is the S&P 500 going to continue moving higher or is it going to back off? Well, let's start with global data. First, we have PPI. Producers Price Index is going to be big. It's happening this Wednesday. And we have jobless claims. We have CPI, but that's not going to be as big as jobless claims. So these are the big reports. Jobless claims, retail sales, that's going to be huge because that's consensus. Remember, retail sales is 3/4 of our economy. 3/4 of the GDP is retail sales. So that's a big number. Again, don't expect a lot of trading action till the second half of the week. Now, let's look at technicals. Again, nothing's been hashed out with China. Trade war negotiations are going to happen on the table later this month. Not expecting anything major. If at all, we're going to see bean counters. And that's a big if. So again, not expecting a lot from that aspect of the economy. Now, it looks like Fed's going to lower rates again later this month or beginning of next month. The market is already anticipating that. So let's look at it right now. Now, I want to show you something, and this is pretty big. Take a look at this. Now, keep in mind, a lot of you guys are looking at the S&P 500. But I want you to look at the New York Stock Exchange and the Russell 2000. Why? Because it has a lot more stocks in it. It has a lot more market cap in terms of overall percentage of the stock market. The S&P 500 has a large market capitalization. So those 500 stocks are extremely influential. But the bottom line is they're still correlated with the overall market. So no matter how much higher the S&P is going to go, the controlling index is going to be the Russell 2000 because it has 2,000 stocks and the New York Stock Exchange. More stocks always wins. The 500 stocks will revert back to the broad market. And that's why it's more important than ever to look at the New York Stock Exchange and the Russell. Now, notice here, the New York Stock Exchange has had one day completely above the 50-day moving average. We want to see 2 days before the market goes back into bullish mode. Now, if you look at the Russell, it's not there yet. It hasn't even had 1 day of clearance. This is a good representation of the U.S. stock market right now. Let's take a look at the S&P 500. This is the Emini. This is open overnight. Now, we've had 2 complete days of clearance now, so officially this market is bullish. Expect us to go a little bit higher, potentially a little bit higher, but not too much higher. There's just not enough buying pressure right now. There's no catalyst. Now let's look at the day session. This is the day session. Look at the RSI. It's already near the 67 point. It's showing us that there's just not that much more upside left. So the most important thing is look for a catalyst, look for more news on China, but right now don't expect a runaway market from the current levels. I wouldn't be surprised if we saw one more higher day or maybe today and another and a move back down. Just not expecting that bullish market cycle that traders are expecting. And the reason for that is, again, look at the Russell 2000. Look at the small caps. They're barely moving above the 50-day moving average. And here's why. I want you guys to understand this. This is important. S&P 500 stocks are conglomerate companies. They have many, many different aspects. In other words, take Johnson & Johnson, for example. It has 500 different products. When you take a smaller company, a company that has a market cap of $1 billion, they're usually a one-trick pony. They usually do 1 or 2 things. And that means there's a lot bigger impact from China or influence from China on that stock, on that company, than the S&P 500. The example I always give people is Dish Networks. Remember when DirecTV came out? I thought it was going to be a killing. And then I found out that the company was owned by a very large conglomerate, Hughes Networks. So it was only a very, very small, very tiny percentage of its market cap. So again, Russell 2000 stocks are more one-trick ponies. These companies do 1 or 2 things versus S&P 500 stocks. And the less the company does, the more it'll be tied into international trade. And ultimately, this is what the stock market looks a lot more instead of the S&P 500. Because the S&P 500, you got 500 of the biggest companies in the world. Sure, they're impacted by China, but to a lot smaller degree. And ultimately, those smaller stocks, those smaller companies, there's so many of them, they will overall guide the market lower. They will put more pressure on the market. And that's why I'm not expecting a runaway market right now. Maybe another day, maybe today will be it, but don't expect a huge upside move from the current levels. There's just not enough of a catalyst, and smaller caps are not they're not seeing momentum just yet. I know this was a little more than I was intending to give you, but I want to give you guys as much as I can so you guys have a good understanding of how the broad market works, how the small caps are influencing the overall market, and the impact on the overall market from China due to the smaller caps. All right, I'll talk to you guys tomorrow, and if you guys are enjoying these videos, please reach out to support@marketgeeks.com and let me know so I'll keep doing them. And if there's if you guys have a question or if there's a topic you want me to cover, send me an email, support@marketgeeks.com. Talk to you guys soon. Take care and have a great week.